You sit in front of the screen, stocks on one side, home prices on the other, and the more you look, the more confused you get. Everyone says these are the two most powerful paths to building wealth. But the more advice you hear, the harder it becomes to see what you might actually be missing. Some people buy property and end up financially trapped for years. Others invest in stocks consistently and still never feel any richer. And the uncomfortable part is this: maybe the real question was never which one to choose, but what actually changes the outcome over the long run. If you still think picking the right asset is enough, then you may be looking in the wrong place. And that is exactly what we are going to break down today. I'm Kevin, not a financial expert, but someone who once thought real estate and stocks were only a question of returns, until I realized that what determines the result over many years operates on a much deeper level. And that pushed me to observe real life more closely, learn on my own, and reflect on very real mistakes to understand what truly creates separation in the long run. If you find perspectives like this worth thinking about, hit like and subscribe so you do not miss what comes next. And in the next part, you will see why so many people choose the right asset and still head in the wrong direction. You will understand what the real leverage is that pulls outcomes apart over time. And you may realize this game was never just about real estate or stocks. There is a reason the argument between real estate and stocks never really ends. It is not because one side is always truly better than the other. It is because most people are asking the wrong question from the very beginning. They ask which one makes more money, which one is safer, which one makes you rich faster. That sounds reasonable, but it is still not the question that changes everything. Because in the long run, what determines the outcome is not just the asset you choose. It is how that asset interacts with who you are, with your cash flow, with your tolerance for risk, and with the kind of life you are actually living. This is the point most people miss. They compare real estate and stocks as if they were comparing two products on a shelf. But that is not what this really is. This is not a comparison between two products. It is a comparison between two life systems. And this is where everything starts getting interesting. A person who buys real estate is not just buying an asset. They are buying leverage, buying obligation, buying maintenance costs, buying illiquidity, buying the feeling that they own something real they can hold on to. A person who buys stocks is also not just buying an asset. They are buying liquidity, buying volatility, buying abstraction, buying the ability for money to keep working while they sleep. And sometimes they are also buying panic when the screen turns red at exactly the wrong time. By this point, you can start seeing the real issue. Most people do not choose between real estate and stocks through pure logic. They choose based on which one makes them feel safer psychologically. That is why one person looks at a rental property and sees certainty, while another person looks at that same property and sees debt, repairs, tenants, and a lot of headaches. That is also why one person looks at a stock portfolio and sees freedom, while another person looks at it and sees an invisible asset that can lose a big chunk of value in a few months. This is not a minor detail, it is the foundation of the whole argument. You may be thinking this, but in the end, is the return number not still the most important thing? Not exactly, at least not in the real world. Because the return on paper and the return you are actually able to keep in real life are two very different things. This is where most people begin misunderstanding the problem. They look at real estate and see appreciation. They look at stocks and see growth. Then they assume the whole question is just which one has the better percentage. But the real number runs much deeper than that. Real estate can give you the power of leverage. You use a smaller amount of your own capital to control a much larger asset. If everything goes right, the effect looks extremely impressive. And that is exactly why it is so attractive. It makes growth look amplified. But here's the question very few people are willing to sit with long enough to ask. What happens when that leverage comes with negative cash flow? High interest rates, repair costs, taxes, insurance, and periods when the property produces nothing at all? That is when real estate stops being a return story. It becomes a story about endurance. Meanwhile, stocks can look much lighter. No roof to fix, no tenant calling late at night, no contractors, no lease drama. No grass growing in the yard, but do not confuse lighter with easier, because the test for the stock investor sits somewhere else. They have to tolerate the feeling of not being in control. When the market goes up, everyone feels smart. But when the portfolio drops hard, you begin to see who you really are. This is where stocks quietly expose your psychology. Can you still believe in the strategy when the numbers on the screen are moving against that belief? Can you still let time do its job when your emotions are telling you to do something right now? The real estate person suffers through friction. The stock investor suffers through uncertainty. And this is where the story becomes much more real. Real estate often gives the owner a stronger feeling of control. You can repair it, raise the rent, renovate it, make direct decisions about the asset. That feeling is powerful, especially for people who hate the idea of their money living inside something intangible. But the price of that feeling of control is usually time, energy, and a more rigid cash flow structure. Capital stays locked up longer. If you make a mistake, it is harder to reverse. If you want out, you cannot exit with one button. Stocks are the opposite. More liquid, more flexible. Easier to diversify, easier to automate. That sounds beautiful, and yes, much of it truly is. But the price of that flexibility is that you must accept the thing many people hate most. Daily uncertainty, no physical object you can touch and call real. No illusion that if you just do one extra thing, you can save the situation. That is why many people say they prefer real estate. Not necessarily because it always performs better, but because it gives them a kind of psychological comfort that stocks do not. And some people say they prefer stocks, not necessarily because the returns are always higher, but because stocks do not force them to turn part of their life into the side job of managing property. This is where the two strategies begin shaping the rest of your life in very different ways. A person who goes with real estate may build wealth faster through leverage, but in exchange, their life often becomes more tied to obligation, repair schedules, interest rate cycles, and physical presence. A person who goes with stocks may miss the feeling of owning something real, but in exchange, they may keep more of their time clean, keep their mind lighter, and keep their life from being repeatedly interrupted by the asset itself. Now look at this through the lens of freedom. If a new career opportunity appears in another city, who can move more easily? If a health issue forces you to slow down, whose asset punishes them less? If you want to downshift your life instead of accelerating forever, which asset supports that choice, and which asset demands even more of your presence? This is no longer a story about percentage returns. This is a story about life structure. The real estate person may become richer on paper faster in some cycles, but they may also live with more stress if the cash flow is too tight, if the property depends on too many things going right, or if they bought too big relative to their own safety margin. The stock investor may feel slower by comparison because there is no key in hand, no tangible asset to show off, no story about the tenant paying the mortgage for me. But they may still go very far quietly if they allow time to work long enough without disrupting the strategy themselves. That is why one case study viewed from the outside is so easy to misread. You see one person make a lot from real estate and assume that must be the right path. You see another person build wealth through stocks and assume simplicity must be the answer. Not exactly. You are looking at the final result, but not the kind of pain each person had to endure to get there. Not the rhythm of life they had to keep. Not the amount of luck involved in rates, timing, location, and their personal ability to tolerate the strain. And this is where, in the long run, everything begins to separate even more sharply. Not the asset that wins on the internet, but the asset that does not break the rest of your life while you are trying to get rich through it. What changes everything in the long run is not whether real estate or stocks has the better year. It is not who wins in one specific stretch and then tells that story as if it were universal truth. What changes everything sits much deeper. Are you building wealth in a way that makes your life wider? Or are you building wealth in a way that quietly locks your life down? This is where a lot of people only see money but miss structure. Real estate can look stronger because of leverage. Stocks can look cleaner because of simplicity, But if you stop there, you are still looking too shallowly. Because leverage does not just amplify gains, it amplifies pressure too. And simplicity does not just make things easier. It also magnifies the need for inner discipline. That is why someone can fail with real estate even while the property itself goes up in value. Not because the deal was completely bad, but because their life system could not tolerate the time, the risk, and the level of attention it required. And someone can fail with stocks even while the long-term strategy is right. Not because the market betrayed them, but because they could not endure uncertainty long enough to let time do the work. That is the part charts never fully tell. If you look at it more coldly, real estate and stocks are not just two asset classes. They are two different tests. Real estate tests your ability to tolerate friction. Stocks test your ability to tolerate volatility. Real estate asks you this: are you willing to trade some lightness in life for leverage, control, and a more tangible way of building wealth? Stocks ask you this: are you willing to give up the feeling of direct control, accept periods that feel awful, and trust a system that does not need your daily presence? That is the real confrontation. Not between property and tickers, but between two different kinds of endurance. And that is why in the long run, what determines the result is no longer which asset you choose first. It is which kind of pain you can live with without betraying your own strategy halfway through. That may sound too psychological, but it is actually the most financial part of the entire story. Because compounding does not only need return, it needs time that is not interrupted. And leverage does not only need opportunity, it needs a person strong enough to stay with it through periods that are not pretty. A real estate investor who keeps getting forced to sell in bad moments will never truly receive the best part of that strategy. A stock investor who keeps changing course every time the market drops will never truly receive the best part of that strategy either. That is why the question, which one is better, usually leads you to the wrong place. It makes you search for an absolute answer when the real issue is compatibility. Not compatibility with the internet. Not compatibility with some guru, but compatibility with your cash flow, your temperament, your time, your pressure tolerance, and your actual life goals. If you are the kind of person who hates uncertainty so much that a red portfolio keeps you awake at night, then stocks, even if mathematically elegant on paper, may not be the thing that changes everything for you. If you are the kind of person who values time, hates being interrupted at night, and does not want assets dragging you into management mode, then real estate, even if attractive in theory, may raise the cost of your life more than you realize. And there is an even deeper layer. The asset you choose in the long run does not only shape your wealth, it shapes your financial personality. Real estate can make you pay closer attention to costs, cash flow, location, leverage, and the physical realities of life. But it can also pull you into a constant state of fixing, guarding, and being on call. Stocks can teach you patience, capital allocation, probabilistic thinking, and the power of not constantly doing something. But they can also make everything feel too abstract, too distant, and too easy for emotion to interrupt if you do not truly trust your strategy. In other words, the asset you choose does not just create returns. It creates the way you live with money. That is why what changes everything is not whether real estate beats stocks or stocks beat real estate. It is whether you realize that in the long run, the asset that lets you stay long enough, without forcing you to sacrifice too much of the rest of your life, is the one that has the best chance of truly winning for you. That changes the whole frame of the game. You stop asking this, which one has higher returns? And you start asking this, which one gives me the ability to stay in the game long enough without distorting my life too much? You stop asking this, what are rich people online doing? And you start asking this, if I follow that path for 10 or 15 years, what kind of person will I become? Will I have more freedom or just more assets on paper but less margin in the rest of life? That is the question with real weight. Because in the end, winning in long-term investing is not only about having a bigger asset base. It is about keeping enough of your life intact while the assets grow. If you are richer on paper, But your time gets harder, your mind gets heavier, your choices get narrower, and everything has to orbit around the asset itself. Then that victory is no longer simple. If you grow a little slower but sleep better, stay more flexible, get pulled back less often, and still have the discipline to let time work, then the picture looks very different. And that is why, in the long run, what changes everything is not which asset looks stronger right now. It is whether you can see which asset fits you well enough to hold for long enough, steadily enough, and honestly enough with the rest of your life. Only when you get to that layer does the debate between real estate and stocks start becoming genuinely useful. You've made it this far, and you're probably starting to realize something. Real estate versus stocks isn't the most important question. You can pick a side, debate the returns, and try to figure out which one is better. But in the end, what actually matters isn't the asset. It's how you use it. Do you use leverage wisely? Can you maintain your cash flow? Do you have the patience to let it grow? Most people don't see this. They keep switching strategies, while the system underneath never changes. The people who actually build wealth don't win because they chose right once. They win because they stick with the system long enough. And over time, that consistency is what changes everything. If this video helped you see things more clearly, hit like, subscribe, and drop a comment with your thoughts. Thanks for watching, and I'll see you in the next video.